So during the March quarter, because of COVID-19, the higher risk options like My Super and Higher Growth had negative returns, and the lower risk options have done a lot better, like cash, diversified bonds and conservative, due to the virus. And remember, if the Australian stock market was over 20% lower, and therefore you've had returns ranging from -2 to 3 in the lower risk options, right up to -9, -10 in the higher risk options. The strategy itself hasn't changed. We run the strategy for each option based on its risk return profile, and we've kept fairly close to the targeted asset allocation. With one exception, My Super's running a bit higher cash, and we're looking to take advantage in these markets that are dislocated, particularly Australian shares if they are a bit lower from here, and credit. Best performing option in terms of return was obviously the cash option. So the cash option held up while all the other options were negative. But I would caution for cash as a long-term investment. Cash rates are nearly zero with the RBA at 0.25. And while cash has held up in these falling markets, for a long-term investor, cash rates are actually lower than inflation, and therefore cash is not a good long-term investment. The most important thing for us at Statewide is this has been a difficult period for our members. First of all, there's a health outbreak in terms of staying healthy and not picking up the virus. Second of all, there's people losing jobs, they're worried about their income. And then third of all, there's their superannuation balances. But I would break it out into two areas. One, if you're young, you have a long time for your superannuation balances to recover. This will be over in time, and when the economies and the markets recover, so will their superannuation balances, and therefore through positive returns. For older members, it's a bit more difficult because obviously we would hope there's a lower risk option that they're in, but they too have been impacted, and in that case it's really a case of giving back some of the money that they've made in the last 7 years. But unfortunately it was a difficult quarter for our older members, and it's important here whether we have the bucketing approach of cash, a lower risk option, and something like the growth option, or just conservative and cash will be enough to basically see you through. But as always, it's important that our members contact us if they need guidance. Simply put, liquidity is, can you get your money in cash if you need your money in terms of a partial withdrawal, early access, or you want to switch from one option to the other, and it doesn't affect the overall asset allocation? And the short answer to that is yes, all the options have been designed to have cash in them, and therefore if people need access to their savings or drawing down their income or switching to other options, we have enough in there in cash that we can move it around and it doesn't impact asset allocation. From our perspective, we've always run very well diversified asset classes and asset allocation throughout all the options. If anything, we have a little bit higher cash allocation to our My Super option, as I said earlier, looking to deploy into these markets. And therefore liquidity and our asset allocation shape in terms of our targeted asset allocation, it's where we want it to be. So we're very comfortable with where we are at the moment. So I mentioned diversification a lot when we communicate. Diversification simply means that we have lots of different asset classes, so if one does well, the other one does poorly, you're not impacted by one or the other. And this is very important when we're running the default My Super option, that we have cash, bonds, Australian shares, international shares, infrastructure, property, alternative investments. And therefore that overall mix means that when the share market goes down, say 20%, you don't actually match it one for one because you're much more broadly diversified. One of the free lunches in investing is to make sure not to have all your eggs in one basket. And diversification is one of the key things we strive for when we build our options. Now, unfortunately, I think we are entering into a recession. I think that applies to Australia and the global economy, hence why the fall in the markets and the fall in superannuation balances. Our best guess is that this will be a short and sharp recession and then followed by sort of a longer U-shaped recovery. It is a health crisis, so until there is a vaccine or this COVID-19 has been eradicated, it will take time for life and the economy to go back to normal. Now, what does that mean for our superannuation balances? It means for younger members, things will get better, and when things become normal, the markets and the economy recovers, their balances will go up. So they have time to do it. For our older members, as I said earlier, you'd certainly want some guidance and advice by having a lower risk option and making sure that you are comfortable with your risk profile.
The advice in this video is general advice only. It may not be appropriate for you, and we recommend you obtain independent financial advice and consider the applicable PDS before making an investment decision.